I'll be explaining how the 2008 US housing crash spread into a global recession. But first I need to explain what a recession is quickly. It'll help you understand this quick video. A recession happens when the economy shrinks for 2 or more quarters in a row. During this time, fewer goods and services are made, and people and businesses cut back on buying things. Because of this, companies earn less money and unemployment usually rises. Here's how it started. This crisis began in America, and to understand how it spread worldwide, we need to start there. And don't worry, I'll keep it quick. American banks gave risky mortgage loans to families who couldn't afford them. These banks assumed housing prices would always rise. But too many houses were built, and demand for houses slowed. Home prices then fell by 30%. That meant people owed more on their mortgages than their homes were worth. For example, someone might still owe the bank $240,000 on a house now worth only $175,000. With house values falling and incomes shrinking, suddenly people couldn't keep up with payments and walked away. Millions defaulted. Banks took huge losses. The financial system began to crack. Credit dried up. Businesses cut back. They reduced hiring, closed down parts of their operations, and tried to save money wherever they could. The US slid into recession, but the damage didn't stop at America's borders. By 2010, the shock crossed the Atlantic. Europe itself was in deep trouble, as European banks were hit too. They held the same mortgage securities. Huge losses piled up as the value of their investments collapsed. Something else serious happened. Banks stopped lending since banks were too weak and too afraid to issue new loans. The huge problem for Greece was that it relied on borrowing to keep its economy running. For years, it spent more than it earned, and cheap loans from European banks made up the difference. But when credit dried up, Greece suddenly had to pay much higher interest to borrow money. Sadly, even their tourism and shipping, its two biggest industries, collapsed, wiping out a major source of income. Families suddenly had less income to put bread on the table. With fewer visitors and less trade, the Greek government's tax revenues dropped sharply. The US and Europe were in recession, and they demanded fewer Greek exports like farm products, manufactured goods, and shipping services. Their debt shot past 120% of their GDP. Spain was hit by the global financial crisis even harder, and I'll tell you how. Cheap loans fueled an extraordinary housing boom in Spain. Nice apartments, hotels, and suburbs rose everywhere. Construction became a huge source of jobs. But when the US crash hit, global credit markets froze. Banks around the world had lost money on US mortgage investments, and they stopped trusting each other. Since banks wouldn't lend, Spanish banks suddenly couldn't get the money they needed to keep lending either. That meant they wouldn't lend to Spanish businesses or to ordinary people, so companies cut jobs and families struggled with less income. At the same time, house values plunged because there were far more homes than buyers. Unemployment hit 25%, and youth unemployment rose above 50%. Soon, the entire Eurozone was on the edge. To the rescue, the EU and IMF offered bailouts to struggling countries like Greece, Ireland, and Portugal. Surprisingly, European leaders and international lenders demanded spending cuts and tax hikes in those countries. Making matters worse, unhappy people in Greece, Ireland, and Portugal filled the streets in protest, angry over lost jobs, lower wages, and shrinking public services. Then Asia felt the big shockwave. Sadly, Japan's export-driven economy collapsed. Major economies like the US and Europe stopped buying cars and electronics from Japan. Poor Japan, reliant on exports, was devastated. Even stock markets in Tokyo and Hong Kong plunged. Shares of companies that relied on exports lost value because global demand dried up. And property shares dropped because construction stopped, projects were abandoned, and buyers vanished. Buyers vanished as people lost jobs. Incomes fell, and many fear home prices would keep dropping. Construction stopped because banks wouldn't lend. Bank shares also fell as borrowers defaulted and investors feared banks were hiding huge losses. Why? Because banks had lent too much during the boom, and many loans were turning bad. So panic spread, investors sold, prices plunged, and trillions in wealth were wiped out. China moved differently during this global crisis. Its government launched a $600 billion stimulus. That was actually 14% of China's GDP. With the West buying fewer of their goods, China turned inward. The money went into highways, railways, and cities. China's state-owned banks lent freely to local governments and companies. Cheap credit fueled a massive building boom, and heavy debts. Chinese construction firms hired workers. The good part was millions of Chinese kept jobs. Their income stayed steady. People kept spending, which helped the economy grow. Surprisingly, the growth of the Chinese economy stayed near 9%. China kept importing iron ore, copper, and oil. that propped up Brazil and Africa. But much of the building wasn't needed. Ghost cities rose. And worse, the burden of debt would weigh on China for years. Just when it seemed the damage was contained, the pain spread further. Developing countries were hit last. As the West sank into recession, demand for raw materials collapsed. Factories slowed. Shipping declined. Consumers bought less. Commodity prices sank, hitting exporters like Chile and Brazil. Even growth in Africa and Latin America stalled. Millions of jobs in farming, mining, and shipping disappeared. The whole world was caught in the storm. When economies are connected, one collapse spreads like dominoes. America sneezed, and the world caught a cold.